Today, ladies and gentlemen, one of the greatest feelings in the world, hands down, is while I've been incapacitated, barely being able to get a bed for the last week, haven't been able to make my own damn money, that the whole purpose of this channel continues to pay off, which is generate passive income through stock market investing, being a Canadian-focused investor. And during this volatile week, we've seen a lot of red, we're starting to see a lot of green again. I figured it's about time that we dive into my individual brokerage accounts that are going to be, again, more relatable to the Canadian audience as we look at the Tfsa, Rrsp, my general managed account, and just those general accounts outside of my corporation to see where we currently sit. And then I want to talk more broadly about what is going on in the Canadian economy, Canadian real estate, and generally things that'll probably be affecting your life. So first and foremost, the Tfsa here, folks. I mean, take a look at this. It's great. I haven't looked at these accounts in literally over a week, and we've got another $274 worth of dividends that we're going to be able to reinvest. And again, this is not as a brag. I post updates to these accounts every week, usually month over month, since the beginning of this channel back in 2019. And if that is something you can appreciate, damn it, hit that like button, because we're all just trying to, save money, invest it, and build these passive income sources. This account today is worth about $156,000 and is starting to see signs of green again after the insane volatile week. Now, I only hold two stocks. Many of you know I've become primarily a ETF focused investor, and my favorite ETF that paid me this $274 this month was VDY. This index, bar none, has become one of my favorite holdings in Canada, and I really think that all of my new money is just going to be pile driven into this one ETF. Now, we'll talk about VOO in a second here, but the reason I love VDY is I've noticed that month over month, the dividend payments are tightening and getting bigger and bigger and bigger. And this month it paid out 0.175 cents per share, which if it stayed up at this higher premium, it would equate to about 4.8%, which would be crazy for this ETF. But right now, I think if I averaged it out, I think it's sitting just over 4% currently. And again, if you guys have never seen VDY before, it basically just holds all the Canadian dividend aristocrats, like the best Canadian stocks that I would recommend anybody buy individually, whether it's Royal Bank, Toronto Dominion Bank, and Bridge, Bank of Nova Scotia, primarily the banks, Canadian Natural Resources, BC Energy, or BC Energy, BCE, I'm still sick, bear with me here, folks, the telecommunication giant that is Bell, that pays a massive yield, and this thing just keeps getting better and better for me, so I'm just going to continue to funnel huge amounts of capital into there by reinvesting probably about $5,000 in the next couple weeks into my managed account that's currently worth about $36,000, which is in the green, thanks to RioCan, Smart Centers, and VDY. This account, when I logged into it over a week ago, I was down pretty dramatically on Smart Centers, and it looks like everything is starting to rebound pretty nicely in here. This is my direct monthly paying account. I am not looking to add any new stocks currently to this account, so I'm really fixated on getting VDY in here up to over 20,000. I got another dividend payment in here this month of $160. My goal, I think right now, all of these are paying me around $1,900 annually. I'd like to see this account dividend income to be over $2,000 annually. It'd be nice to get this up to about $200 a month. It's going to take a little bit though. It's probably not going to happen this year. Might take it the next year, because obviously I want some extra capital to invest in the tax advantaged accounts, which also we could talk about my Rrsp, which is currently worth $61 or just under $62,000. No dividend payments in here because unfortunately these are all quarterly, but my Rrsp, I've mentioned this 1,000 times in the past, guys. It is really great holding US dividend paying stocks in here because you don't pay any over the border withholding tax. And I've also concentrated this account down after the wicked rallies and gains from Tesla and all these stocks. I've kind of slapped myself into reality saying I've got too much money to manage, so let's refine it down into just a few ETFs. So for this account, I fixated primarily on not only ETFs that can grow, but can pay very good dividend yields. So we've got SCHD, which I know is a massive favorite amongst the dividend community, and then the Vanguard Index Fund, VYM. I think SCHD is a much better dividend stock, but VYM, it just because it holds all of the dividend stocks I love, like Johnson & Johnson, and it weights them in a way that I like, even though it's underperformed SCHD. I figured I would go with the best of both worlds and just split the money up pretty evenly between the two. And then again, I try and get most of my growth from VOO, which I leave in my tax-free savings account, because in the future, if I ever decide to sell VOO and I want to pull some of those gains out, it'll be much more tax efficient in here. And because VOO doesn't pay such a high dividend yield, I'm going to pay withholding tax in the Tfsa, but because it's only on like 1.5% or whatever VO pays, it's very incremental. So you can kind of see how I've fixated some of these accounts. Now, I know many of you would want to know what's going on in my corporate account, and I promise you soon I will be doing videos on that. I don't think people realize, I didn't realize how complicated corporate tax would be. But nonetheless, I want to talk about this, guys, because it seems like you look at your portfolio, and if you've been doing things diligently and cost averaging into this market, and you've kind of done the path that I've taken here, which is the path of least resistance into index funds, which isn't going to be for everybody. If you're younger, I don't know what your circumstances are. Just where I currently sit today, it just seems to be the decisions I'm making. It's been boating out very well. I've got a lot less volatility in my portfolios, and these dividend checks that equate to over 10,000 annually between all my accounts are definitely being proven prudent when I do not have time to be making as much money as I used to because I've been sick. But when I log into my accounts and I go into the news terminal, it's pain. It just, everything about the general markets is going to try and stop you from achieving exactly what I'm doing here, because there's a lot of fear. It just seems like, ever since the pandemic hit, we stepped into the twilight zone, and it's like every 6 months there's something new that is just driving fear into your investment decisions, which is not good. Because the geopolitical stuff continues. The stuff with China seems to be getting insane, and they say it's going to affect everybody globally. This crazy housing collapse that could happen there. And then I'm like, let's just focus on my own economy. So I log into the Canadian economy stuff, and here's a Bloomberg article saying real estate holdings drop by a record $322 billion in Canada. Household net worth falls 6.1% amid interest rate hikes, but rising commodity prices bolster corporate bottom line. I love this last little saying here because obviously Enbridge, some of these investments that you have in these ETFs are, actually performing very well. And that's what gives you the performance of, when some things don't do bad, the things that are doing better make up for the difference, because we can never really predict what's going to do well and when it's going to do well, but obviously things definitely circulate. So I'm going to read through this because it's crazy. Canadian households experienced a decline of almost $1 trillion or $775 billion in net worth in the second quarter amid plunging prices for homes and stocks. The value of residential real estate holdings held by households fell by $419 billion in the 3 month between April and June, while financial assets dropped $531 billion, Statistics Canada reported Monday in Ottawa. The thing that I find most intriguing about all of this, guys, is Canada is primarily a real estate driven economy. It's where most of the GDP comes from outside of our banks. And it's crazy if you want to know why the Canadian banks are so big and they're the monopolies here is because of our real estate market. Obviously all they're the money made in the loans and this booming economy is largely inflicted by the real estate prices. But however, who's not making any money this year, and it's becoming a problem because I'm seeing it as I deal with my own taxes, is the government. They're not making money off you. You have to think this is the first year where in a decade there is going to be no capital gains on real estate, which means there's no capital gains tax, which means the government's not getting paid off the number one booming sector in the entire economy outside of commodities in Canada, which is crazy. So the government is looking for new and innovative ways to continue to make money. And I guarantee they're going to come knocking on your door, whether it's going to be crypto related or something, but they're going to want to make that money up somehow. But anyways, in total, household net worths fell 6.1% or $990 billion, the largest drop on record. The number illustrated the extent to which higher global interest rates are destroying household wealth in Canada, adding a major headwind to the nation's slowing economy. The average resale price of a home dropped by 10.5% from this first quarter, the statistics agency said. But where things get intriguing is always at the end of these articles. Let's continue to read. The drag on net worth from housing is likely to persist into the second half of this year, with Canadian home prices still falling and borrowing costs expected to rise farther. I think after this year, maybe into the midst of next year, is when we start seeing everything nominalize, because these interest rate hikes honestly are not that crazy yet. But the Bank of Canada increased its policy interest rate by 0.75 of a percentage point to 3.25%. Think about that. We're only at 3.25%, guys. We're not talking about 5-10% interest rates here. Like, this is very low, and the whole economy is freaking out. But it is expected that there's going to be another hike next month by another 0.5 point. The rate was holding at an emergency low about 0.25% until March, because obviously the pandemic, they took the rates to basically zero. But I don't see them doing any more major rate hikes. You got to think the last rate hike was 0.75%. I think they said they wanted to get it between 3.5% and 4%. But I just don't see them doing anything crazy because inflation is cooling. So they're not going to continue to hinder us with interest rate hikes that are massive. Still, households remain much better off than they did before the pandemic. This is the funniest statement. It's like you read through all this horrifying factual news, and then out of nowhere, they're like, guess what? Things probably not that bad. Yeah, well, not as bad, because with net worths at 2.9 trillion, higher than at the end of 2019. So even before the pandemic, we're still doing better than we were back in the end of 2019. So the value of residential real estate held by households is still up $2.3 trillion over that time. Companies did much better in the second quarter thanks to the rising prices of commodities that are offsetting the drop in household wealth. The net worth of corporate sector jumped by 812 billion. So even though your stocks are down, typically those companies you're holding in your ETFs and these Canadian stocks are probably doing relatively better. Household credit market debt as a proportion of disposable income rose 181.7% from 179.7% in the first 3 months of 2022. So it's kind of a mixed bag, right? This is the general news cycle. It's like you can either take the top of the headline and presume it's all hell-based, but when you go back, and this is what I keep saying, is go back to anything post-2020, and we're still doing much better than we were at that time. It's just like, it's so hard to gauge out the twilight zone that we're in right now and how bad it is, and sometimes it comes back to the point that you need to take news as entertainment. I do not try and take the news as literal investment facts that you can somehow think you're going to end up better off on the other side of this by listening to it. So it kind of comes back to that point, guys. It's entertainment value, and continue to cost average and stick to a strategy that works, because again, my accounts are doing fairly great. There's no complaining here, but when I turn that news on, it seems as though a nuclear war could start breaking out at any time, and I'm sure it absolutely could, but it's not something that you can base a strategy of investing off of. But I want to pass the question off to you. I'd love to know what you guys think about all this in that comment section below, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.